Welcome to our latest Moonfair Deal Talk edition today. My name is Stefan Pauls and I'm the founder and CEO of Moonfair. I can't say it much. I'm so delighted to welcome Blythe Masters as a guest of our Deal Talk here today with us. Before we go into the session, let me remind you there will be an opportunity for a Q&A at the end. So please hand in any questions you might have and we will call them out at the end in the Q&A session. Blythe, you have forged an incredibly successful career in the financial industry. You started your career at JP Morgan Chase back in the 80s, and you became a managing director at the incredibly young age of 28. At that point in time, the youngest person to achieve this status in the firm's history. After many successful years with JP Morgan, among others, including as chief financial officer of JP Morgan's investment bank, but also head of global commodities, you choose a fundamentally different path. You joined a startup that in that point of time was one of the earliest movers in the blockchain space, before eventually joining Motive as a founding partner in 2019. A very, very warm welcome. Fantastic to have you with us, Blythe, today at the Deal Talk. Let's turn into the questions. Can you tell us a little bit more about Motive, please?
I'd be happy to. And firstly, thank you, Stefan, very much for having me and for your very kind words. Indeed. So what is Motive? As you said, it's a young firm that came into existence back in 2016. We are a 100% fintech specialized private investment firm. Some might say fintech obsessed, actually. We're super focused. And we are stage agnostic investors that have the capacity to back firms all the way from the pre-seed and venture capital stage through growth capital and ultimately buyout capital as well. So at every stage of an entrepreneur's evolution. And basically what we exist to do is to build, back and buy the companies that enable the global financial economy.
Look, let me dive into this, Blythe. You started your career out in a different space. And why did you choose to get into private equity in general? And then in particular, as you mentioned, fintech obsessed, why did you decide to specialize in fintech?
Well, by the time I left JP Morgan after a 27-year career there, during which time I had done quite an array of different things for the bank, both building and managing bigger businesses, as well as risk and control functions. Obviously, I'd had a fair amount of exposure to financial technology that powered that enormous financial services business. And by 2014, I had developed a point of view that there was something going on in the fintech space that was somewhere on the spectrum between scary and very exciting. I wasn't entirely sure which, but also that was largely, relatively speaking, ignored by the industry that I knew so well. Not surprisingly, because if you think about the 10 years since the financial crisis, from 2007 onwards, the major financial firms were focused on other things, really, than driving innovation through technology. They had a more existential series of challenges. But these new upstart firms were really demonstrating that the evolving power of new technologies that were coming of age in that period could really be used in the financial services space to do a much better job of serving customers, whether those be individual consumers or enterprise. And that fascinated me and led to both my decision to run a fintech startup that was an early mover in the enterprise blockchain space, and subsequently to move from an operating role into an investment role at Motive, a firm that was focused exclusively on fintech. And obviously, as we've watched what has ensued Subsequently, there's no doubt that what is going on in the fintech space represents both an enormous investment opportunity, but a very, very powerful force for change in terms of improving the efficacy, experience of, and access to financial services in the world.
I will come back to the fintech space in a sec and have a couple of questions, of course. In this regard, allow me to stay for 1 minute on and lean on your experience with JP Morgan. You said that 27 years with the firm. How has this time shaped your approach to investing and risk management in private equity?
Well, probably the best way to describe it is actually to talk a little bit about Motive's relatively unique operating model, which we refer to our IOI model, where we combine investing with operating and innovating capabilities within the firm. Of course, as an investment firm, it goes without saying, table stakes are the ability to have sophisticated investment capabilities. But relative to most others, we over-index in terms of our resource allocation and focus on in-house operating knowledge and in-house innovation and technology capability. Back at JP Morgan, I was an operator for obviously many, many years that made use of financial technology, primarily in my case around investment banking and capital markets, and saw the power of how technology drove change in that space. Just to pick one example, I saw the wave of electronification of markets during the course of the 80s and 90s and into the 2000s that was really quite extraordinary in terms of its scope and impact and scale. When I left JP Morgan, I became an entrepreneur and an operator, combining my financial background with newfound technology knowledge. And it felt like a natural step from there to switch to being an investor professionally with all of that background. So really, it's the operating knowledge that I had whilst working at JP Morgan, the entrepreneurial and innovation knowledge I picked up as a CEO of a startup that I'm now using as an investor at Motive. So I'm using essentially everything I learned through the course of a admittedly long career.
Very, very insightful. Like you mentioned, today's economy is highly volatile, and you mentioned the global financial crisis. Having lived through it, in a senior position at JP Morgan these days, what were your biggest learnings from that time, and how are you applying them today?
But I think having had the opportunity and frankly the privilege to work at one of what has evolved into being one of the best run and largest global financial institutions on the planet, I had a ringside seat and sometimes a role as an actor in some of the most volatile and challenging market conditions, both around the period of 2000, 2001, the bursting of the dot-com bubble, the merchant energy crisis, and the market sell-off that ensued. And then again in 2007, 8, 9, and beyond. And having lived through those periods of turmoil, you learn a lot about what it takes for financial services businesses to survive and thrive. You also, unfortunately, learn a lot about what it takes for them to fail. And ultimately either disappear or be subsumed. And those learnings have certainly helped inform my post-JP Morgan career as an investor, particularly as it relates to understanding how the demand for financial technology is driven from those financial firms as these cycles come and go. The good news about financial technology and investing in it is that you're far less sensitive as a general rule for most businesses, not all of them, but for most of them, to the ebbs and flows of market conditions, transactional volumes and the like. If you are investing in businesses that are providing mission critical infrastructure that enable those firms to stay connected with their customers and serve those customers in ways that help defend their competitive moat and make them more effective operators. And interestingly, as the going gets tougher, the incentive for major firms to rely on technology as an avenue for reducing cost, improving efficacy, reducing capital requirements, improving customer stickiness and embeddedness goes up. So many lessons from those periods of volatility.
Yeah, look, I couldn't agree more, really. One, I keep on saying one of the major differences, facing today's volatility and to some extent crisis that have to be managed is that the same persons in many cases are still in charge that have and can take their learnings from the past. So couldn't agree more. Look, let's move a little bit into the fintech space. And look, everyone at every cocktail party is talking about ChatGPT, and it has been a wake-up call, it seems, for many people to spend attention to the topic. Even Bloomberg more recently announced its generative AI model, a specific Bloomberg GPT dedicated for financial use case. How are these, in general, developments that we are seeing in AI and the fight, the battle between the giant tech firms? How is this impacting and changing the financial industry? And what will be, associated to the first question, in your view, will be the largest disruptions that we have to will see, and which business models are threatened and others that might emerge?
Well, it's a great question. Always dangerous to answer questions where you're asked to predict the future, but I'll give it a bash. Candidly, I think this situation in some ways reminds me of the phase one of the evolution of widespread adoption of the internet. So thinking back to the very late 90s, early 2000s. At that stage, though, everyone was looking at this sort of new phenomenon, wondering, would anyone ever really trust the internet as a destination for doing business of any kind, e-commerce business, not to mention financial services business. People doubted that. They weren't really sure what it meant. No one yet had the ability to really predict, what social media would be, or that social media would become a thing. And yet, we look back now and realize that was the beginning of a wave of change that really changed everything about the world as we know it. And then by the time 2009 or so rolled around, the smartphone, the iPhone was released. And things accelerated again with the adoption of mobile and all of the interactions that has facilitated. Thinking about generative AI, which has been a thing for a long time, but not really commercially deployable because of the sheer cost and compute capacity that is required to really make it effective, as there's been this exponential expansion in the capacity of both storage and computational capability. Generative AI now really is coming into a world of its own and has realistic prospects for immediate commercial deployment. Although one shouldn't underestimate the costs associated with the extraordinary compute and storage demands that will create. I think relative to the 20-year-old example I gave you of the first wave of the internet, I think it's rather more obvious to us today what are the implications of generative AI than what were the implications of the arrival of the widespread adoption of the internet way back then. It's pretty clear that many activities that involve computationally intense, analytically intense, reading intense, research intense, writing intense inputs and outputs are going to be threatened and potentially displaced in large part through AI-driven capabilities. I tend to try to be positive about this kind of technological change, There's no doubt that there's risk that jobs will be put at risk. Just in our world, thinking about certain trading activities, certain research activities, certain customer interactions that are today done by humans that perhaps will not be in the future. Those jobs may well be lost. I believe that AI, though, will also contribute to the ways in which, for example, we learn, and that we teach the next generation of personnel the skills that they need to survive and thrive in the workplace. And so my sense is that in just the same way that technology in the past has displaced, it has also fueled growth and created new job opportunities and certainly better ways of serving customers in a variety of different ways. So I think this is a massively important development. I think it is going to be as big as the internet was in 2000, 2001, as mobile was in '09 and beyond, at least. And as it relates to fintech, that this will be one of the areas most impacted by the advent of this technology, generally beneficially. Super, super exciting.
Look, Blythe, this is resonating. It's interesting, really, very much with our view here at Moonfair. Bill Gates here recently said at the Munich Security Conference that he considers AI even to be a larger movement and change than the entire internet. And if there's one thing for sure, as we speak, an enormous amount of resources, but in particular also money, is flowing into the space, not only from the Googles and Microsofts and the big five tech firms, but also from the venture industry. So there is an incredible dynamic environment. And we at Moonfair, we are observing the space very, very closely to identify the best investment opportunities on behalf of our community. Look, let's move a little bit into the macro world, and stating the obvious, the world has changed at a dramatic pace over the past 12, call it to 24 months. We have seen an unprecedented rise or speed of rise and interest rates that, of course, has fundamentally changed not only the fintech valuations, which is a mathematical topic, but also called into question some of the business models, the viability of the business models out there. Which business models would you say have, were in fashion for some 12, 14, 24 months ago, are questioned right now and which might not have a future at all?
Well, I think there are examples of them across the spectrum. There was an environment that really ended last year where, due to the rate environment, the monetary policy environment, there was extraordinary investor appetite to support businesses that were pursuing growth over almost every single other objective. And there's many of them. You can see them in the buy now, pay later space. You can see them in various payments applications. There's some of the neobanking capabilities. There's a long list of businesses that could, in principle, be run with different objectives, but were created and operated in a fashion that didn't pay attention to the long-term sustainability of profitability in the business, and they were rewarded. In fact, it's one of the sources of some of the more entertaining C-suite expletives that I've encountered over the years was the reaction of mature financial services businesses to the relative valuations of the old-fashioned, out of fashion, unfavored but profitable business models that were unable to fund themselves with the ease that others that really didn't have any clear path to profitability whatsoever. That obviously has more or less completely reversed itself today, with far more focus on sustainability of profitability, and or at least very least a clear path to that. And one of the challenges for some of the young entrepreneurs out there is that some of them haven't actually had the experience of dealing with those less friendly capital markets and how to actually run businesses for sustained profitability, over the long term. They get easily put into a position where they are pressured to cut costs, but shrinking your way to glory is not an easy an easy path. So those that always had the basic business discipline had a path to profitability, or were pursuing it anyway, are finding life a lot easier today than those that did not. And obviously, those that were prudent ensured that they always had a long enough runway to endure a period of drought, that they could continue to invest while their competitors were suffering, are those that are really doing best. And, some of the portfolio companies that we have at Motive are fortunate in that regard, fortunate or wise in that regard. One of the factors that led to our picking them, that actually are able in this tough environment to take advantage of their relative strength in positioning to grow market share at the expense of others that were more challenged. And I don't think this period of shakeout really is by any means fully ended, to be honest with you.
Yeah, look, you are saying that the past 10 years, probably for many, if not all industries, have been what I call honeymoon times. And those
Yes.
are over. And I believe for the young generation of founders and entrepreneurs, it's very healthy that they now, have to learn to struggle more troubled water, call it.
Yep.
And I'm sure the entire industry will emerge even stronger also from a management capability standpoint. Let's talk a little bit about what's ahead of us. And you said that no one can read the future. That's clear. But what are the challenges in the fintech industry in particular? The major challenges companies face over, let's say, a period of the next 12 months, in your view?
Well, I think, for some fintechs that serve, major financial services firms, there are actually real opportunities in this business because the demand curve for their capabilities is actually going up in this tough operating environment. So companies that offer their customers the ability to outsource, streamline, and operate at lower cost and better efficacy, functionality that is non-core and doesn't represent a proprietary competitive advantage, are actually seeing the demand for their services in this environment go up. One challenge that all firms, fintech or otherwise, are facing is of course inflationary pressure. The cost of labor has mounted, not to mention other componentry, but labor in particular in this environment. And again, there are many entrepreneurs that really haven't paid attention to the fact that they need in their long-term contracts to have inflation indexing baked in. And even some of those that have that, at least in principle, haven't actually had the experience of navigating the tricky conversations that you have to have with your customers about actually effectuating your right to increase prices. So there's a whole chapter and verse that that we have to work through with many companies, just literally just working through how do you handle contracting and recontracting and renegotiating business in this environment. I think you make another good point about regulatory scrutiny. It is becoming clear that regulators around the world, financial regulators in particular, but not limited to the finance space, are more and more acutely aware of the risks presented by technology vendors to their regulated businesses in a first order sense. And those risks obviously come as the scale of fintech service providers grows, but also as risks in the form of cyber vulnerabilities and resiliency, availability, all of these things that have a knock-on effect on the ability of businesses to perform, particularly in a high stress or a high risk environment. As you know, also in the last few months, the market has been in, let's call it, search and destroy mode, looking for the weakest links in the financial ecosystem. We haven't had yet, although there's clearly a risk of that, severe asset quality problems in the financial services space, but we've had significant liquidity problems, and that combined with the risk of loss of confidence either in business models or in the viability or security of companies has led to some very high profile bank runs and collapses, as you know. And interestingly, those developments were actually, in some senses, exacerbated by the availability of digital capabilities. So the fact that social media can disseminate noise at the speed of light, the fact that you or I, and indeed institutions, can withdraw money from a financial institution using a phone, a tablet, or a laptop, and resulting in withdrawals in the tens and tens of billions of dollars in a single day is quite extraordinary. So regulators are very, very focused on all of these concerns. None of the post-GFC reforms really addressed any of that, and you're going to see a wave of regulation that is thinking about cyber, about social media and noise dissemination, about liquidity, and so on, that will increase the cost of doing business in financial services and will create some opportunities for fintechs who are able to address that on behalf of their financial services customers.
Blythe, it's so refreshing to listen to you, and I can feel, and I'm sure the audience does as well, the passion for fintech. Let me round up the section here around fintech by asking you, what excites you most about it? Is there any particular angle that you would mention that really, triggers your passion that everyone can feel?
Well, that could take the rest of the session and beyond. But let's see. I would say, first of all, the scale of the opportunity. The way we think about fintech, it's not just the spend that financial services firms incur on technology that drives their businesses or fuels their businesses. It's also the spend by non-financial services firms that have a desire and a need to embed financial capabilities within their businesses. So between embedded finance and direct fintech, that's a $10 trillion revenue opportunity for fintech firms to go after. So scale, I think, number one. Number two is complexity. We as investors embrace complexity. We find it fascinating. Our in-house technology capabilities means that we have the ability to, as well as operating knowledge, the ability to create, have context and create real conviction in what we do. And having that capability makes being an investor a lower risk proposition than not. So that's, I think, super exciting. And then the last thing I would say is the sheer distance that the financial services sector still has to travel. Back in 2015, I used to dine out on making a comment that, it seems pretty extraordinary that we have autonomous self-driving vehicles on the streets, or back then we're about to, and yet we still can't manage better than, what was then T+3 and is still, T+2 settlement, for getting cash in return for selling your equity in many markets. The financial services sector, relative to certain others that have been completely transformed by technology, still has quite a long way to go. And that's before you start imagining the capabilities of generative AI and other things that really have yet to come into full focus. So lots of things to be excited about.
I hear it. Look, Blythe, we talked a bit about your phenomenal career. Let me ask you, how did you transition from being a CEO of a startup, a technology startup, to becoming or being an investor?
Well, I needed to find the right home, and what I was lucky enough to find in Motive was not only a group of people that I truly admire and genuinely enjoy working with day to day, but who are absolutely convinced in a different way of doing private equity investing, with this proprietary investor, operator, innovator model. And given that I, in my career, have had the opportunity to do all three of those things, finding a firm that had that as its core value proposition was what attracted me into the space. Not to be pejorative about private equity as a general rule, but there are instances where you could think of private equity as being about buying a firm, adding some leverage, cutting a lot of costs, and flipping the resulting company that's looking a bit fitter and leaner for several increased turns of multiple expansion. That just doesn't excite me. What excites us at Motive is the ability to drive value creation through the deployment of technology and to be able to see that opportunity before it's obvious. And as you can tell from the things I've been talking about, I really, really enjoy that. So that's why I found a home at Motive.
Thank you so much for this. Look, as you might know, I've spent quite some time as an operator with KKR in the private equity industry and have a natural, call it, fascination for operating models. And why is it? Because, as you said earlier, value creation is all what it is about. It's generating alpha. And you at Motive, you're pursuing a quite unusual model combining investors, operators, and innovators. You touched a little bit on it, but can you, and I'm a big believer in examples, can you give me and the audience an example of how you applied this operating model and how it was driving the success?
Well, just to clarify, for the benefit of our watchers, we have approximately 200 in-house technologists. That is not something you would find at most investment firms. So these are people that they're not pushing PowerPoint. They're engaged in writing code. Of course, they're involved in due diligence and the underwriting of companies, which provides us the conviction behind the opportunity, whether that's identifying older technology that could be renovated or best-in-class technology that we just want to get behind and really help drive with growth capital. Beyond that, actually working directly with our portfolio companies on their technology roadmaps and helping them where there's a need and a desire, actually in some cases execute the delivery of those roadmaps, both helping them with build versus buy choices, but actually also the build in many cases. So those are the ways in which we function differently, I think, than other firms. And that's all informed by a number of executives who have backgrounds like mine, who have run companies, whether it be startups all the way through to multi-billion-dollar public companies. Jeff Yabuki, our executive chairman, for example, ran Pfizer for 15 years in his tenure. By any measure, one of the most successful public fintech CEOs of all time. When he looks at businesses in the banking and payment space, has extraordinary in-depth knowledge around where the bodies are buried, where the opportunities lie, and the ability to pursue that. So there are many examples of it, but it's really the context, the conviction, and how deeply we work in partnership with our portfolio company entrepreneurs that differentiates the model.
Look, I hear you. We at Moonfair, we are big believers in this active ownership model, and the best players and largest players out there, they all pursue it. The way I understand it is that you are quite differentiated, having these 200 people, with a very clear tech vertical focus over and above, senior experience as a manager, as a founder and CEO. Let me ask you, during your time at Motive, what are the three most important things you have learned at Motive when it comes to deal making?
Okay. So the hardest thing about this question is limiting it to three, because I've learned a lot. I think one thing is it's about starting early. If you show up and meet a founder after, bankers have been engaged and you're invited to participate in a round, you've lost all the opportunity to really deeply get to know a business and the people that are running it, that will differentiate both the quality of the job that you can do for them, but also the quality of the opportunity that you can create for yourself. So I think developing early proprietary relationships has been absolutely critical. The second thing would be not to shy away from complexity or opacity. There's no lack of that in the financial services and fintech space. A lot of these businesses are just a lot harder to understand, both in terms of their risk and their opportunity than more conventional businesses in other industry sectors. That means that there is a very legitimate role for specialization, and having specialized knowledge and focus really differentiates your ability to develop the context and conviction around situations where there is complexity, opacity, and where you have to think several steps ahead. We've done a number of investments where we combine companies over a period of years, where the vision was there from the start. The execution took years, but the vision was there from the start. A great example would be the company that is today InvestCloud, which over a period of 2 or 3 years was the combination of 3 distinct companies, one of which was a carve out from a much larger company, Fiserv, and the others were standalone companies. Today, that is one of the largest financial marketplaces that connects manufacturers of investable product with distributors. It's like $6+ trillion flowing through the pipes of that platform. Another similar example, focused on the alts space that we love a lot, is Case. Sorry to mention a competitor of yours, but a great company who's focused on taking the process out of the lives of investment advisors and getting them back to doing what they do best, which is advising their customers. As you know, the process associated with investing in alternatives is horrendous, frankly. Much too much paperwork, PowerPoint, paperwork, PDFs, and so on. So these are great examples of things that we've enjoyed digging into the complexity and seeing the opportunity there. The last thing I'd say is, we have learned to avoid super high risk guesswork. So while we get super excited about very early stage technologies that have great promise, we don't add great value by being able to select the winners and the losers in very early stage evolving technologies. So take the blockchain space as an example. Early on, that was a space we haven't been heavy investors in, because selecting the winners and losers in that early technology evolution is really very difficult to do. What we're much more interested in is, as that technology matures, investing in businesses that already have a moat, already have a network, and could deploy a new technology successfully through it, whether that be blockchain or generative AI, and where we see the value that can be created in monetizing that network. So those are three examples of lessons learned, although I think probably I made that something more like 6, but I'm going to label them as 3 lessons.
Thanks so much, Blythe. You mentioned separating the losers from the winners. And one thing there, and apart from technology and business model and sustainability of business models, one thing I particularly found compelling and difficult, at least in my career, is really selecting and backing the right founders and CEO. Based on your experience, can you share with us? And I personally made another, by the way, mistake. I always waited too long to separate from certain managers in my career, and I try to overcome it. But can you share with us what you look for in a leadership team? What are the characteristics that make you feel comfortable about the ability to execute and drive the business?
Yep. I mean, you're absolutely right. This is an absolutely critical part of the ingredients. Our business is backing entrepreneurs, and so finding the right teams to do that at the right stages is a critical capability. As you know, also the right leader at a founding and early stage of a company may not be the right leader at the scaling and later stages of the company. And so to your point, having to make those decisions and evaluations is an important part of the ingredient. But essentially what we look for, first and foremost, is a team and a CEO that their teams are willing to follow with great enthusiasm. So it's the ability to create followership. Great leaders create followership. There's no one recipe for doing that. So you can have a whole array different styles. And in fact, if you met every single one of the CEOs of Motive's portfolio companies, you, I think, would be quite surprised at the diversity of approach, of style, of experience, because leadership comes in many different forms. But having people whose people believe in them is step number one. The second thing I would say is around transparency. If you're going to accept other people's money at scale into your business in a meaningful way, you have that fiduciary responsibility and working with your investors in a way that makes them feel embraced and most importantly, in our case, where the leader will take advantage of the capabilities of the firm. If you're only accepting money from Motive because it's money, you're working with the wrong firm, because you're leaving 2/3 or 3/4 of the value proposition on the table. So transparency and engagement, the willingness to talk about the challenges and the areas of opportunity, that's what we look for, because that's where we do the best job in supporting the people that we back. And then the last thing that I would say is a conundrum. We look for, on the one hand, people who have the confidence to lead through uncertainty, through pivots, through horrendously challenging market conditions, yet at the same time have the humility to know what they don't know. And it is a rare bird that combines extreme confidence with an appropriate degree of humility. And looking for that is something that we're always on the search for.
Impressive. Thanks so much for sharing. Look, Blythe, last year or so, you raised your latest flagship fund, and congratulations, by the way. I think you closed at 2.5 billion or so. But since then, stating the obvious, the economic landscape and in particular the fintech industry has changed quite a bit. How has your approach to evaluating investment opportunities? How has it changed to adapt to the new reality?
So it's interesting, actually, because in the space that we operate in, we call it fintech, but I should probably define that a little bit for you. We're not typically investors in direct to consumer businesses, nor businesses that have heavy risk-taking balance sheets in their own right, nor heavily regulated businesses, although there are always exceptions to that. Or partial exceptions to that. We may invest in a bigger business that has some component of its business that involves that. Rather, what we invest in is software businesses and associated business services capabilities that serve financial firms, for a living. And that sector hasn't been as impacted by the change in economic circumstances as those businesses that are, directly interacting with consumers and that have heavy risk-taking balance sheets and so on. Everybody, of course, has been affected by the changed inflation environment. Everybody is affected by, or many people are affected by, the changed transactional environment. We have some businesses that have transactional sensitivity. In those cases, we were careful to ensure that those businesses had ample cash on hand, because we knew cycles come and go in financial markets in particular. Forge would be a great example of that. This is a company that operates a marketplace for private equity securities of pre-IPO companies that are still private, and associated services around that space. Has been adversely impacted by the decline in activity in the space, but has had sufficient capital on hand to be able to use this period to continue to invest in building the capabilities that will serve them well as the cycle picks back up again. These are the things that we've been very, very focused on: ensuring that that businesses have sufficient runway, ensuring that they have or are already or have a path to profitability, that the path that gets them there is not a strategy of shrinking to greatness that's based on hope, because that's a tough path. Cutting costs to be leaner, to be prudent is critical, but selling the family jewels, is or just starving your business of investment capability is pretty fatal. So those are the ways in which we've changed our our thought process or the way that we're currently working with CEOs. But actually, by and large, from our point of view, the change in environment has increased the opportunity set for us. Because frankly, we were struggling with valuations 12 to 24 months ago and walking away from all sorts of interesting opportunities that were just priced to a point of insanity and beyond. And it was frustrating. The sort of sobering up of markets has meant that valuations today are just a lot more attractive than they were. There are still amazingly great businesses and leaders of businesses out there. I think that 2023 is going to prove to be a really interesting vintage year. And as I say that, I'm speaking about venture capital all the way through to growth buyout and take private situations. So lots of opportunity in this environment.
Look, Blythe, I couldn't agree more. And we are spending, with our research and content team, quite a bit of resources on exactly analyzing and undermining with data what you've just said. People, you will remember this post, the dot-com bubble, 9/11 said tech is dead. Then we had the great financial crisis, the same theme, that tech is dead. Now some people, I heard even in the industry saying tech is dead. The contrary is true. The best vintages,
Absolutely.
all data show this, are, during times of crisis. And we have seen incredible valuation contractions, of course, in the fintech space, in the growth space, in some cases down 60%. I have also, quite deep insights into how the valuations in private markets develop, in particular in the US, and they came down nicely. So probably one of the
Yep.
best vintages to invest. I fully agree. Look, I would
They
love
took
to.
their time. They took their
Yeah.
time to come down, but you're right. They've come down.
No, it's totally true. Some people didn't, adjust to the new reality, but at some point in time they have to. And these are still great companies. So it's a promising time, I would call it. Look, I would love life to continue this, and hopefully, we will have time at another occasion. But it's time to wrap up. And before we go to the Q&A, I would love to ask you one question that I'm always asking in these deal talks, which is, what would you advise your younger self if you would go back 20 years in time?
I've recently had to think. I've been asked this question a few times, as you might imagine, over the years. And generally speaking, I've given an answer which I'll share with you. But then I'll share with you another answer that I've had to start thinking about to supplement that. The first thing is, if you're not enjoying what you're doing, find something else, but don't become a grasshopper. Because if you believe, if the grass is always greener, you'll never land and stay somewhere long enough to build the capital, intellectual capital, political capital, experiential capital that you need to become really valuable in what you do. But we work such long hours; it's grueling no matter what you do. You have to enjoy what you do. So follow your heart and ensure you find a place where you enjoy the people you work with and the substance of what you do, and the rest will follow as long as you work hard, do your homework, and show up and turn off that snooze button that you referenced in your video earlier. The thing that I've had to start thinking about more recently is, me 20 years ago had an opportunity to learn in a completely different way that the young people of today are enduring. And I think I had it easier than they did, because I didn't have to deal with going through school, business school, in the case of my daughter, for example, during COVID, or starting a new job during COVID, and then living in a world of hybrid, or in some cases, vast majority remote interactions. And I think about the way that I learned. I learned by observing people, by interacting with people, by talking to people, and it was spontaneous interaction. It was not scheduled, and it was not in these horrible 40 or 30 or 60-minute intervals, in two dimensions where reading, many things, including, the whole picture, is very hard to do. And I think that is a real challenge that the youngsters of today face. You or I, we learned all of that stuff in a different era and have it. And now, we quite enjoy interacting over Zoom because it's more efficient. We don't have to spend time traveling. But for those still learning, it's a challenge. So don't underestimate, for those at the beginning of your career, the importance of direct human interaction finding those relationships, fostering the opportunity to have a mentor, to have a sponsor, going out of your way to take advantage of the opportunities that you can create or are presented to you, to interact in person. I can't emphasize how important the human aspect of building business relationships is, and not falling into the false sense of security that just because everything appears to be happening on Zoom, that's how the winners will win, because that's not how the winners will win.
So true what you are saying. I couldn't really agree more, and it is so valuable to share this insight. It is really this is what it's all about the human being moments, and in particular in person. Look, let's move. We got dozens from questions from the audience in the system. In the meantime, let's move to the Q&A, please. And one question to start and kick it off with is: you mentioned your experience in enterprise blockchain. Do you think this space will ever have its own ChatGPT moment? Many people have talked about blockchain for years, but the breakthrough is not yet at least visible, I guess, to most people on the outside.
No, I don't think it'll have a moment as obvious as that. To the extent that that moment was going to occur, it was back in 2015, 16, or 17, sometime around there, when the concept became popularized and better understood, and the distinctions between crypto and distributed ledger technology began to be understood. The challenge is that with enterprise blockchain, that the network effects that it exists or has the capability to exploit and take advantage of also act as impediments to change. And so the sheer cost and complexity of the change needed, for example, to shift post-trade infrastructure involving multiple independent parties from one framework to another is what stands in the way of more rapid adoption. I'm not by any means suggesting that enterprise blockchain is dead or will not ever rise to its full promise. It's not dead, and it will rise to its full promise. It's just not going to have a moment where everyone says, aha, let's go. The opportunities will arise, for example, as different jurisdictions embrace things like rapid accelerated settlement. So the opportunity for T+1 or less settlement in securities will drive the adoption of DLT-based solutions. A great example of that is the project that DTCC here in the United States is driving for precisely that purpose. And there are many others. And so over time, you'll see adoption. It's just not going to happen with that kind of an aha moment, and it won't have the kind of direct consumer embrace because enterprise blockchain is all about the behind the scenes stuff. And in an ideal world, the consumer of it shouldn't even need to know that a blockchain is involved.
Very much also, frankly, aligned. Blockchain, this is a fundamental technology, and it's there to stay. One question we've got here, we touched on, the firm's Motive's unique operating model, but there seems to be even more interest to understand it in more detail in the audience. The question is, how does your operating model, Motive's operating model, work and seek to drive a better ROI than that of more traditional private equity firms?
So private investing starts with obviously evaluating and underwriting a new company. Your ability to do that requires that you develop, you understand the context within which its opportunity exists, and then develop conviction in that company's right to win or ability to win in that context. We use our in-house operating knowledge and our in-house technology capability to be able to identify and develop that context and conviction. That reduces the risk of making any given investment. If you have people in-house who've been there and done it, or have actually run the businesses that are at risk of being disrupted by this new company, or have run the businesses that might be a buyer for this new capability, then you can understand whether this company is onto something or not. It's just one example. If a company is at a later stage, has an existing network but has perhaps been a division of a larger company that has been unloved because it's been non-core. The company's had other higher priorities, for example. It's typically going to be demonstrating the attributes of being unloved. It's going to be slow growth. It may have customer attrition. It may have new competitors that are arising. How might we make an investment by buying that business? We'll make that investment by understanding how one could invest in the capabilities of this underloved business to modernize it and drive value creation, and in fact offer and create a new management team. In this case, we may be bringing in a new management team. So find the new management team. Where do we go to find the management team? We go to the Motive network of in-house and external relationships. We very often have Motive executives running companies that we're turning around in the C-suite, including at the CEO level. Not always, but very often. So, and having that in-house knowledge, again, reduces the risk associated with making tough decisions to invest in businesses that from the outside world may not look to have that great opportunity. And then in some cases, we work alongside, hand in hand with our partners in portfolio companies to accelerate, not just with our money, but with our technology building capabilities, their path to delivering the best product available in the market, which very often at the point at which we're investing, they do not yet have. And that can accelerate their path to profitability or their path to success, in many cases by years, certainly many months. And having that ability to draw on resources that have skin in the game and knowledge, not just going to an outsource technology vendor that isn't aligned, it doesn't have financial incentive to see your company succeed and really is just incentivized by what you pay them. It's a very different prospect. Working with technologists who reside within a firm whose very success depends on your success makes the choice of working with Motive a much more attractive one for many entrepreneurs where they need that help. Not every company needs that help, to be clear, but it's available where the opportunity arises.
Blythe, look, that makes perfect sense to me. Look, unfortunately, time is flying. We have so many more questions, and but we will not get there in time. So let me thank you. Really, that was so insightful, Blythe, for your time, for your insights, for everything that you have shared with us. Terrific to have you with us today, and also a big thank you to the audience for listening into it. One last remark. There will be a poll coming up. We really want to learn. We want to make this format better and improve over and over again. So please, it takes 2 minutes or so to fill it out, share and give us please your feedback. And then, I hope that everyone is dialing in for the next Deal Talk session, which is scheduled for June 20th. You will all receive an invitation. Thank you so much for your patience and for listening into our Deal Talk today, and hope to see you soon all again.